Hi guys, today I'm going to be talking about the breakout strategy that made Christian Qullamagge's account go from $5,000 to $100 million in less than 10 years, and we're going to get right into it. So in this video we're going to be talking about the risk management, indicators required, the actual strategy, and how to trade it. And just a reminder guys, if you like this sort of educational content, make sure to leave a like and subscribe as there's more to come, and make sure to leave me a comment if you want anything specific for me to do next. So, first of all, risk management. Qullamaggie recommends no more than 30% of your account to be held overnight in any stock or ETF in case of any large gap downs based on news or anything like that. He also rarely risks more than 1% of his account on one trade. In terms of positions, most of his positions are between 10 to 20% of his account size, which is around 5 to 10 trades on at once, and risk per trade is around 0.25 to 1%, but he recommends more for small accounts, around 0.5 to 1.5%. So the indicators used in this strategy are moving averages, particularly the 10 SMA or EMA, the 20 SMA, and the 50 SMA. He also uses volume and ADR/ATRs, they're basically the same thing. And we'll go into more about how these indicators work and how to use them in the strategy in our trading portion of the video. And I'll also link below a trading view indicator that contains all three of these indicators together if you want some simplicity. So the actual strategy is described in 3 steps. Step 1 entails a big move higher sometime in the past 1 to 3 months, and at least a 30% move that lasts a few days or weeks. Step 2 contains an orderly pullback and consolidation with higher lows in a tightening range, also preferably with low volume. Step 3 is a breakout of the consolidation that lasted around 2 weeks to 2 months, and consolidation should be surfing the rising 10 and 20 moving averages. So I'm going to go more into in depth of these steps in the next slides. So step 1 is a big move higher sometime in the past 1 to 3 months. At least 30% of that move lasts a few days or weeks. So this is an example from Axon Enterprises in actually 2004. So what we're trying to show here is that this strategy has been working for a very long time. It works in any asset class, any stock. So as you can see here, we're looking at here, so 3 months before that it's had around a 42.96% gain. So for step 2, we want an orderly pullback and consolidation with higher lows and a tightening range. So we have orderly pullback, higher lows, tightening range. And also we can use volume here. We want volume that's drying up, so relatively less volume than what we usually have. Then lastly, step 3, we get the breakout of the consolidation that lasted around 2 weeks to 2 months. This was around a month or so. Then the consolidation was surfing, so it was around the 10 and 20 moving averages. So the white's the 10, the blue's the 20, and then the purple's the 50. Ignore the red one. So we had the breakout above it, and this breakout, as you can see, it went from around, what is this, 730, and then to a high, as we can see, around like 13. So we're going to be talking more about when to actually buy it, how to buy it, and then where to place your stops in the next slides. So how to buy. First of all, to find these stocks, we want to scan for 1 to 2% of stocks that are up the most over a 1 month period, a 3-month period, and a 6-month period. So these are basically the best of the best. We want to find the best of the best stocks. So we want to identify these setups before market open. Ideally, we should have alerts set so that we get notified whenever it breaks out. And you should also know how many shares you want to buy. So we want to enter on either 1 minute, 5 minute, or 60-minute opening range highs, also known as opening range breakouts. So what this actually means is that, so say for example, 1 hour time frame. So this is the first 1 hour candle. Well, it actually isn't, but just for example, this is the first 1 hour candle. So the opening range high would be there. The low of the day would be here. So what we're doing, we see this breakout from the range. Obviously, this is again not a good setup. I couldn't go back far enough on the TradingView free plan. So if you guys want me to get the TradingView Pro plan where I can do some back testing, subscribe and a like would be appreciated. But so we're waiting for breakout of the first 1 hour candle. So we get that right here. So ideally we'd want to buy right here. And then now for our stop, we see stop is set at low of day and should not be wider than the ADR of the stock. So what that means is that if we bought right here, our stop is around the low of day, which if you calculate it, it's 3.8% down. We can see here our ADR is 10.43%, so that means ADR means average daily rate. So that means on average, Mara moves 10% in a day, which is obviously a humongous amount compared to other stocks like Apple or Netflix that only move 1% a day. And this is what these types of stocks are what Qullamaggie calls gold. So an ADR above 5%, that's what Qullamaggie aims to trade. As anything lower than that, you're not really making much profit for the time you're spending. So we can see here that 3.8%, that's obviously lower than our ADR, which gives us a favorable risk to reward. So now we're going to go on how to actually manage the trade when you're in profit or if you're not in profit. So now how to sell. So his rules are we want to sell half to 1/3 of the position after 3 to 5 days. And then we want to move the stop to break even. The second step is we want to the rest of it, we want to trail the stop on either the 10 or the 20-day moving average. And we want it to close below it so that like it doesn't fake us out. So close below, then we exit out. He recommends beginners stay on the 10-day moving average, close below it, and then more advanced, obviously 20 days. So now for an example of this, so we looked at this before, Axon Enterprises, the breakout above it. So initially the stop was low of day down here. It never got hit. So he says 3 to 5 days after you want to take off half the position. So 1, 2, 3, 4, 5. Say you sold around the close of the day. That would still net you a 34% profit, which is obviously very good for a swing trade. Then that's half the position off or third of the position off. Now we want to wait for either a close below the 10 or the 20. So in this case, a close below the 10 would be down here. So that'd be a gain of 37%. But if you were more of an aggressive trader like Qullamaggie probably would be, you would wait for a close below the 20. So right here, that's again not a close. It faked it out, came back, it closed up here. A close below, the first close below would be here. So that still nets you a return of 64%. If you could get a guaranteed fixed income thing for 64%, you would obviously take it. So this trading strategy is obviously very good. The only downside, well, some people might call it a downside, this strategy is very, well, relatively low probability. Qullamaggie himself around 20 to 30% win rate, but the winners obviously outsize the losers here. So say you stop right here, maybe you lose like 2% to gain 65%. Obviously that's very good risk to reward. So that's actually all I have for you guys today. Thank you for watching. If you guys enjoyed this content, please make sure to leave a like and subscribe. And please leave some feedback. Obviously, I'm a new channel. This is my first video. But I'd love if you guys can tell me what you want me to improve for next time and what sort of ideas you want me to record. Anyways, thank you guys for watching. I'll see you guys next time.